would be playing for a move. This is just a swing trade, basically, the way that I see it anyway. I'd be playing for a move, maybe not all the way up to 30 cents. If I'm going to risk, all the way down here to below the 50 period, if I'm going to risk, 8 points, 8%, then I've got to be able to do like 25% at least on the upside. That risk reward has to be like 3-1, something like that. I'd probably, if this pumps higher, I'd start exiting the position at 22 cents. That's where I would set a stop down here at like 16 cents, maybe like 16 and a half cents. And then the take profit would be up here at 22 cents. And the moment that I've got a profit on this thing, I would probably roll that stop up just so that I lock it in and don't have to worry about it anymore. And then as if it pushes a little bit higher, I start to add to it. So the challenge that I've been facing recently is if I'm thinking about things in R terms, so risk unit terms, and things go my way, right? So let's say that I get long Canton, things start pushing to the upside, and I've got like 0.3 R in profit. If I roll my stop up to break even, I would need to roll my stop higher than that. So if I get the stop up to 0.3 R and then I add another 0.3 R, it's almost like I haven't actually added any more risk to the trade, but I've increased the notional size of the trade. So that's the pyramiding. But it's very, very difficult for me to do that because as I roll the stops up, I don't like the idea of rolling up the stops and then on normal market noise, getting stopped out for a profit, but a much, much smaller profit than what I believe I should have had. So I'm still working the system out for myself, but I definitely like the idea of using R, using risk units instead of using dollars. It changes something in my brain a little bit, makes me think about this a little bit differently. It's better, I think. ETH giving it back, look at that. So dumping again. Yeah, Ramon, go ahead.
To your point about R, I don't know if you can hear me. Can you hear me?
Yes.
I started using GVZ and then the other measure for silver volatility, and it was really helpful. Just kind of looking throughout history how high the GVZ and the silver volatility had gotten, and it kind of helped make the decision. Hey, you know what? This is probably prudent to shave some off here. So that was helpful. Just thinking in terms of similar to what you're saying of like, dude, look at the risk here and volatility representing risk. Maybe it's not 1-to-1, but I thought it was helpful for me.
It definitely is. Gold vol up here at 45. I don't think it's ever been this high, or maybe it has. Let me just go ahead and zoom out to a weekly. Yeah, so the last time we saw gold vol up here was during the pandemic crash in 2020. I saw a chart of gold vol the other day, and it was a different measure of gold volatility, and it dated back all the way to the Lehman crash. Oh, I know, I remember what it was. It was gold vol compared to bond market vol. And the last time gold volatility was as high as it is, and bond market volatility was as low as it is, the last time we saw that was Lehman. So I don't know what that means, but just something to know. So let's see here, you guys. I really wanted to take a look at a couple of protocols here today because I wanted to enter a new position, another one of these PTs. I really, really like these PT positions because, for 100 days or 50 days, if I'm able to earn 10 or 12%, that's pretty cool. I like that quite a bit. And then if I can lever this, even better. And I want to also check in with everyone about the performance of those positions that I entered last night. So really interesting. Take a look at this, you guys. So this is that gold LP. Let me go ahead and refresh this thing real quick so we can just get some better data here from Robert. So remember, no leverage. I'm not using any leverage here. And this is the LP. So this is actually a concentrated LP. Both tokens are the same. It's gold paired with gold. So it's Paxos gold paired with Tether gold. So PaxG, XAUT. Very, very narrow fee tier, 1 basis point fee tier. And that means that I can get very, very narrow with my range. And so this range, I actually set this to be quite wide. This is actually a wide range here. And I wanted to set this range wide. Look at the limit prices, 1000 to 101. So that's a wide range for this pair. And I did that because there are events that last for, minutes or hours where one token moves a little bit more than the other. They're not perfectly pegged to gold. And so this position is doing 78% fee APR right now. Now, I expect that to move down towards 10% fee APR, but with the crazy price action today in gold, a lot of volume. So this was my initial entry. And what I wanted to figure out with this is, does this act like spot or not? And here's how I'm measuring that. So I've got this short position on gold that I entered immediately after I entered the long LP. So here's the LP, and the LP is down $123. So I'm measuring this in US dollar terms. I entered with $1,250, both of these positions. So this is minus 123, and this short position is plus 121. So very, very close to, it's very, very close to true delta neutral. This LP is acting like spot, which is so interesting because it's basically a replacement for spot that is generating right now 78% fee APR, which is kind of crazy. And even when the volumes come down, I expect this will still do like 9 or 10% fee APR. So really, it's just a matter of making sure that if we just take a look, let me make sure I'm in the right market here. So here's the gold market on GMX. All I need to make sure of, and look at the funding. So the funding right now in the gold market on GMX is plus 153%. So it's positive to the tune of 153%. So right now, I'm delta neutral in gold, earning 153% on the short leg and 78% on the long leg. Now, I expect that basis to contract. I don't expect it to remain like a 200% basis for very long, right? What I do think could happen is this goes down to plus 10 and this goes down to plus 10. Now, here's how I could lose on this trade. If the volumes collapse in this gold pool and all of a sudden this is doing 3% fee APR, and at the same time, funding over here on GMX on the short leg becomes very negative, then I would actually be paying to keep the position open. So I'm monitoring the funding closely and I'm watching the yield, the fee APR here closely. So far, so good. And I'm just thinking about scaling this up a little bit. But this is really, really interesting because now it kind of opens up a whole new world. If I can find a bunch of tightly positively correlated pools where both assets in the pool are either some type of stable coin maybe, or ETH paired with some ETH LST or LRT. You could do this with SUI, you could do this with SOL, SOL paired with a SOL LRT, SUI paired with a SUI LRT. You could even do this with Bitcoin tokens. The only thing is you really need there to be volume. You need there to be volume, and wherever you get short, you need the funding to be very positive. That's really the thing. So, hey, this is working really, really well. Wanted to share that with you guys. Let's check in on that Euler position, the levered position on plasma over here on Euler. And I gotta say, my experience with plasma has been excellent. I just need a better bridge onto and off of the plasma chain. So this is doing nearly 30% right now. And this is staked USDAI maturing. This is the PT maturing 19 March. So that's doing 12.57%. And I'm borrowing USDT against it, paying 5.14%. And I cheat looped into this position. So I deposited, I bridged over 25K. That bridge was really expensive. So when I was bridging last night, the bridge that I used was Li-Fi and Relay. If anyone knows a better bridge to get onto and off of plasma, I would love to hear it because I used the bridge built into Ravi. And, if I just take a look at that, it was kind of a mistake. So the bridge button right here, if I click on that and I go from plasma to mainnet or vice versa, that bridge is very expensive.